lasting impact. And today I have my special guest. He's the global head of corporate development of Three, none other than Mr. Kevin Stotman.
Thanks for having me on, Danny.
Welcome back, Mr. Kevin, to one of my podcasts. And can you please introduce more about yourself that I missed?
Sure thing. And it's great to be on again on a different Daniel Lucas podcast. 21 years in real estate, a lot of time across the world helping big companies grow, and now the last 6 as a software executive. And on the side, growing my own real estate portfolio. So that's where the entrepreneurship comes in.
Definitely. And thank you so much for sharing your knowledge and wisdom to the world, Mr. Kevin. We salute you and we are so grateful for doing that. So today let's talk about that something what is called the smartest real estate investors are using this technology. Interesting, Mr. Kevin. For the smartest investors who'd edge because they had access to better data or faster comps. You're arguing that 2026, the edge is gone. What is the new dividing line between investors who outperform those who merely survive?
Well, there's been a lot of money sitting on the sidelines. There was a famous saying that got cliched for the last few years, and that was survive until 25. And everyone did that. And now 25 is over. So
Mm,
now we're in a time where transactions are going to happen because they're going to be forced, because banks have been holding on a long time. Maybe they refinanced. Uh, Investors, LPs are wanting their money back. We've got little toddlers that want results all the time.
no worries. No worries at all.
And
Well,
because of that, you have a lot of people that are saying, look, I wrote checks or I underwrote loans, and now I need to realize a return on those. So the
okay.
transaction activity is going to be a lot more frequent, a lot more common, and the spread is going to thin. So because a lot of that big money is going to be competing for a lot of the same types of deals, what we would call core real estate deals, office, retail, industrial, the edge comes from finding more unique real estate deals, things that are mixed use or where the purpose of the asset is going to change. It's going to repurposing or changing the property type's focus. And it's hard to do that unless you have access to good data.
Very well said, Mr. Kevin. So the specific phrase emerging in the prophetic world, agentic AI, not just analysis, but autonomous reasoning and execution. Walk us through what AI agent actually does in investment workflow that human analysts, even a brilliant one, simply cannot replicate.
So I think AI at this point actually does very little that a experienced, intelligent analyst can't do. Uh, what it can do, though, is not take breaks. What it can do, though, is collate mountains of information and produce a result much faster than a human analyst could. So, where the main power comes in today is if you are a fund and you have a very specific buy box and you're evaluating a bunch of deals, now with just one analyst, you could cover all of the deals that are being emailed to you from brokers via marketing circulars or phone messages left by owners, right? You can now sift through hundreds of deals in a single day to get to the small handful that actually deserve deeper due diligence from that human analyst. That there are a bunch of other use cases, but in the investment world, that is table stakes asterisk number one for AI.
A company called Smart Bricks just raised $5 million from Anderson Howard to turn real estate into a computable asset class. What does the phrase actually mean, and what does it imply about a $300 trillion global real estate market that it was computable until now?
Yeah, I think so many companies have been trying to quote unquote automate the underwriting process and remove emotion from the process of finding, underwriting, and transacting in real estate. And honestly, I just don't believe the thesis. I think real estate is a very relationship driven and emotional industry. Yes, data can absolutely help. Data can help you avoid higher risk for lower returns, but the idea that you can just automate everything related to a real estate transaction, I think is actually completely bogus. And that's not to say that Andreessen Horowitz is not a very talented, very successful, very smart firm. Uh, but also, they wrote a $400 million check to Adam Newman's Flow to buy multifamily properties, trying to get it at a tech company valuation. And I think they're going to take a bath on that one.
You have investors who will still pride themselves on gut feel, on knowing neighborhood is walking it, or relationships and handshakes. Is it intuition now, liability, or it can be augmented into something even more powerful?
So I think intuition in relationships still help you leverage asymmetric information, right? Maybe you perhaps know some city council members who might be more amenable to a zoning change or a zoning request in a particular neighborhood, a deal that some random person who got AI data driven recommendations couldn't get done because they did not have that relationship. That's where that relationship really matters, where that gut really matters, because you know something in your neighborhood that someone else doesn't. But at a macro level, right? All of that flood of data and helping you sift through a bunch of potential opportunities to determine where the relationships will actually give you the edge, that's what matters. It's this intersection of a lot of macro data and AI helping you narrow in on the handful of deals that look good if you can leverage relationships to take advantage of that opportunity.
Mr. Kevin, walk me inside the cockpit of a sophisticated investor using this technology today. They are looking at the market, say Miami or Dubai. What does their screen show that the competitor's screen does not?
So,
Mhm.
first, they probably have little ones giving strong opinions and helping them. It always starts with the same stuff, right? It starts with sales comparables, so you know what a similar property might go for in the market if you already owned it today. You
Mhm.
have lease comparables, so you know ideally what you could rent for in the market. You also probably want permitting information, so you know what other competitive supply might be coming on the market once you own this asset in Miami or Dubai. Um, and then outside of comparables and foot traffic and demographics, you probably also want data on hiring. So, what companies are nearby that are actually growing, that are going to be providing the employment, and that could be a growing tenant is good for an office building. Their high employee count is good for retail and e-commerce spending. Their growing needs for logistics mean a push on industrial. Their compute demand might drive data centers. So understanding the growing company needs and hiring, in addition to all the other data sets I told you, is altogether a really good picture of what matters. But anybody with a deep budget can buy that data, and then using a company like Cherry or other analytics platform can pull it together into one model. Where you get the alpha, where you get the edge, usually is going to be some creative, experienced person who's thought about things that the data isn't showing. Right? I know these three people on the city council. They might change their mind, or this asset, someone attempted to rezone it 2 years ago and it failed because they didn't go meet face to face with members of the neighborhood and spend time with them at church or cookouts or sporting events, right? It really is that last mile, to use a pun, that matters once you've gotten the data in place.
Very well said, Mr. Kevin. The term underwriting has historically meant weeks of spreadsheet torture and broker calls. SmartBricks claim to automate 99% of that workflow: valuation, due diligence, negotiation, and financing, and it compares to minutes. What is the 1% they cannot automate? Is it where human beings should be spending their time?
Yeah, so I think a lot of the reason why it's taken so long to get underwriting to be automated is because you are dealing with, primarily risk averse institutions who are just getting a spread on capital, right? So a bank is going to take in as many deposits as they can. They use those deposits to then reallocate them into loans, and that spread is how they make their profit. So they're going to be very careful with the loans that they underwrite, because if they have bad debt or losses on those loans, that gets rid of that profitable spread from the deposits they took in. The reason why that matters is because some of these new firms, these private credit firms, they're willing to take on a little bit more risk and be able to be a little bit more creative in their structuring. So maybe they're not just having an interest rate in debt. Maybe they're taking warrants on the real estate investment or a piece of the GP in the opco. So you can automate a lot of that underwriting workflow, understand what documents you need to bring in, that would help you make a no go decision. Maybe you're also underwriting and automating the data room, the upload of documents, um, digital signatures, background checks, stuff like that. But creative structuring is probably not going to be automated. That's going to be done with a human element.
Very well said, Mr. Kevin. Beyond acquisition, another layer of this story is about portfolio optimization. Mark is deploying AI agents that read every vendor contract across 25,000 plus unit portfolios and flag overbilling in real time. How much money is literally sitting on the table, billed and paid? The investors do not even know they are losing.
A lot more than everyone thinks. The world of vendor management is extremely fragmented, and even the largest services firms in the world, I'm talking CBRE, JLL, Cushman Wakefield, they've built practices around how to make sure they can use their pricing power as property managers to, get unit economics advantages for vendors. But it's so hard as you go into local markets to really take advantage of those pricing advantages when it comes to labor. So for materials and parts, you can figure that out a little bit, and you can, I think, recover some very obvious overpayments for materials. But labor is a little more complicated. So the open question that we have not answered yet is some of that fragmented labor, can how much of it can actually be solved by AI, and how much of it is a very analog set of labor, like lifting things and moving them, or having conversations with somebody that need to be face to face and can't be handled by a bot.
So, Mr. Kevin, you have AI that can analyze a 300 plus dimensions of data: satellite imagery, building permits or population flows, policy changes, and predict the land value with 85% accuracy. What happens to the developer who relies on the three-page camp sheet and handshake with the broker? Do they even know they are already obsolete?
So I think what is always still the open question, especially with a real estate development. So not you're buying a stabilized asset and you're trying to improve operations. I mean more of a, you're going to be creative with a piece of land to build something on top of it to produce a bunch of value. It's usually all the projects that are flashy and glossy and have big renderings of what it could be in the future, and they get all the headlines and the excitement because those are the projects that are creating a lot of net new jobs. That's the stuff that data and AI can't yet solve for. So they can predict a appraised valuation of the land as it exists today based on the infrastructure that's been built in the land. But what it could become is always quite variable, and there's a high range and it's open for debate. And so I think AI and automation and data analytics will be able to wring the margins out and chew the fat off of the more core assets that are stabilized, that have a lot of track record and history. But for anyone that tells you they're making brokers obsolete for ground up development, unique mixed use projects, that is just, we're not even close to that.
Mr. Kevin, let's do a scenario. You have a 55-year-old investor who has made 50 million over 20 years using the way we have always done it. They look at this AI native stack and they feel what? Fear, skepticism, and of course, contempt. How do you talk to someone whose track record is their identity?
Well, one, you recognize that they've already made it. If they have $15 million, right, they're already set for life themselves. They already can set up their children for opportunity. So, but why wouldn't you then take some of that allocation off the top to bet on the future? They very likely, when they first started in their career, did not follow the status quo to build that wealth. Because if they did, they probably wouldn't have ended up with $15 million in the first place. At some point, they took some risk with some money. And so they need to recognize that, like, that discomfort is normal, but it's probably what helped them build their wealth in the first place. And they need to embrace some of that risk if they want that nest egg to continue to grow and support the things that they want for them, themselves, their families, their friends, their colleagues.
Very well said, Mr. Kevin. You have an institutional fund within a team of 40 analysts. You have a single retail investor with $500,000 and subscription to an AI native platform. Who is the better underwriting, and what does the do concept of accredited investors advantages?
It depends on that single investor's track record and what lessons they've learned investing before. So AI is absolutely helpful because if you learn how to use AI correctly, you can say, what questions have I not asked? What am I missing? What do I need to think about? And what do I need to recognize? And AI has the power of history and tens of thousands of transactions and the equivalent of multiple PhDs. So if you have an honest back and forth conversation with the AI, you can have a lot of power of many analysts and many billions of dollars in funds. But what you don't have is a room to debate with people who have scar tissue, who have learned from failure. And I think that that's the most important thing about that big fund with a bunch of analysts is they can, if they're honest with themselves and they have radical candor, they can recognize where deals didn't work and what they've learned. Sometimes these big funds, if they're on fund 16 and they have 20 billion in capital, they think they know best, and they have their own blind spots they don't recognize.
Mr. Kevin, the Chinese real estate tech analyst I read stated that by 2030, we may see fully automated transactions, AI agents matching buyers and sellers, negotiating price, executing executing blockchain settlement, all without human intervention. Do you believe that this is inevitable, or is it a regulatory or psychological ceiling?
I think from a technology perspective, it will be possible by 2030, and almost nearly inevitable that there will be multiple platforms competing to do that. I think the regulatory landscape to allow that to happen is probably less clear, and it's probably completely dependent upon jurisdiction. I think this is where the the idea of democracy in a laboratory is valuable. You'll have some countries that are more open to this type of thing. You'll have some countries very closed. In the United States, you might have some states open to it and some states that are closed. So I'll be excited to see like how that all plays out. This will be more of a regulatory hurdle, not a technology hurdle. Oh, you're on mute, by the way.
You for sure that must be exciting if a capital can flow instantly to the highest risk adjusted return anywhere on earth. What happens to a local real estate market? Does Miami compete with Dubai on a continuous real-time basis, or does that smooth volatility or amplify it?
You know what? I've never been asked that question, and I don't know. That'll be interesting to see. Some of it will just be access to information, right? If what you said is true and everything ends up on some sort of blockchain, and the user interface is such to where everybody can see all of the transactions happening anywhere in the world, you will see capital compression and cap rate compression. Uh, but probably only for the property type transactions that are happening often enough to be statistically significant. So, a single family home purchase, a condo purchase, an apartment building, a logistics warehouse, what we would call core real estate asset classes. Where I think all the interesting stuff is going to be happening over the next decade or so is going to be what we call emerging real estate asset categories, which just really haven't been defined yet until recently. So think what we would have called industrial outdoor storage 2 years ago. We just didn't have a name for it, and now we do. People that invested 2 years ago before it had a name and recognized that niche have made a lot of money. I think there are a lot of little categories like that that are coming that a blockchain based system probably wouldn't take advantage of, but that it would be more human intuition driven until it's an established, branded asset type.
Very well said, Mr. Kevin. So, what are your short term and long term goals as a global head?
So, one, we're always trying to figure out how we can scale without hiring more people internally, and that does not actually mean leveraging AI. That means finding partners that will use their distribution network to resell our platform, and so they can sell their own services and features and products. At the end of the day, we are a data management platform. I think that is also the wave of the future for many companies. It's how will they retain their top talent, their best people that they trust, and then scale up driven by outside partners that they don't have to pay ongoing base salaries. They just pay for performance. It becomes a win-win situation.
Yes, good luck to your goals, Mr. Kevin, and looking forward for more success. And what will be your piece of advice for those people out there who want to be a global leader like you?
Uh, you're always going to feel risk and things that you can't do. I call that being outside the intuitive fence. At least that's what my executive coach calls it. I encourage you to always be thinking what's outside the intuitive fence and just go for it, because the worst thing that happens is you learn something new.
Yes, go for it, people. Stop procrastinating. So, Mr. Kevin, you are advising 25-year-old with no track record but high AI literacy who wants to compete with legacy institutions. What is their unfamiliar advantage, and what's the single biggest mistake you see a young investors make when they are over indexed on technology?
So my first piece of advice to them is like just go for it, because sometimes there's a huge advantage of having no bias and no preconceived notions. When you're going in, you might be able to think things differently, approach problems differently, solve them differently. But the biggest problem they often take is if they like do one good deal, they take way too much capital at one time and then get pressured to deploy it. And then because they've never handled this kind of money before, they feel like they just need to go spend it. So they hire people, they deploy a bunch of technology that doesn't talk to each other. They just do a lot because they think activity creates ROI, and that's not true. It is intelligent activity that's, risk controlled that creates ROI.
And that'd be awesome. Before we wrap up our discussion for today, I'm inviting you to please don't listen to my other podcast, people. My other podcast, because my abstract essay is already in sixth season, abstract poetry in third season, and my book 101 review in sixth season as well. Comedy 101 in fourth season, food 101 in fifth season, geography 101, love letters, a movie 101 review, music 101 our fifth season, science 101, sex 101 fourth season, spiritual awakening, trivia 101, law 101, mental health 101, motivation 101, entrepreneurship 101, and book 101 are my baby podcast, or Bible verses 101 are my baby podcast. Please listen to them wherever you listen your podcast. So, Mr. Kevin, imagine it's 2036. A young investor asks you what was like to invest before AI. What is the one aspect that analog era that you will miss, not for inefficiency but humanity?
Oh, wow. I think so many people, because young people especially, because they're growing up with digital devices, they're struggling to have human interaction. So I just hope they retain that ability to be able to have a face-to-face conversation and enjoy life outside with other people, because life behind digital devices is not nearly as fulfilling as life with others.
Yes, people enjoy life because life is too short. Mr. Kevin, thank you so much for your time. And can you please invite the listeners to support your advocacy, your business, or whatever projects that you're doing right now?
Yes, please come find me on LinkedIn, Kevin Stoffman. I'd love to keep the conversation going with any of you.
Yes, people, let's support Mr. Kevin Stoffman, because if you support him, for sure, more and more empowering advocacy like this to rise. So, Mr. Kevin, thank you so much for your time.
Thanks for having me on.
What can people see you soon?